First line, and it's true, know your banker. That is the one thing I'll tell you with bankers, they want to know who you are. They want to know your business. If you get to know your banker and you have issues that come up, they're probably going to help you more than if you don't. The one thing you can't do with your banker is put your head in the sand. Get them the information timely. As I think Houston said yesterday, bankers are lazy. Isn't that sort of a comment? Oh, this morning, okay. But what you do is get the packet ready for them on it. You know what they want? They want your tax returns. If you get a financial statement by an outside CPA, they want that. And they want the owner's personal financial statement. Just be proactive and get it for them. And they'll help you out a lot more. Like I say, let your banker know you. Here's the next one. Does he understand or she understand your industry? A lot of bankers don't get you guys. What we get a lot of times is, okay, I got your financial statements, I got your tax returns, why don't they agree? Well, because we're doing completed contract for tax, we're doing percentage completion for financial statements. There are not a lot of bankers out there who really get your industry. Does anybody here have a banker that really gets construction, you think? You do? Okay, that's good.
That's cool.
That's good. And you feel like yours does, right? So that is good. And then we say communicate regularly. What does that mean? Meet with them once a quarter. Let them know who you are. What I hear from bankers is, I want to get the financial statements on a quarterly basis. So if there's a hiccup, I'm okay because I can show 3/4 of things going well. So that's just a hiccup. So you want to give them, the more information you give them, because I think they're in a way higher regulated industry now than what they've ever been.
If you make it easier for them in the loan approval meetings, and then like when they have to review your financials with their bosses, they'll love you a lot more.
Right.
Because in a sense, you are the salesperson for the customer, right?
That's correct. Absolutely.
Take them to your job site. Show them one of your best homes. Walk them through it. Show them what you do. Show them how beautiful some of the stuff is.
They probably don't know.
They don't know.
No, that's probably as good of a thing that you can do as anything else. Here is what we build.
Lenders lend money to people, not companies.
Yep. As we also said, remember we said yesterday, determine your banking needs. Don't get a long-term asset with short-term debt. Because remember, we went through those ratios, and they're going to look at those ratios. If you're buying equipment, get a long-term loan. I see too many people put things on their line of credit that don't belong on their line of credit. They really belong in a term loan, and that just messes up your line of credit. The other thing, what is the term we use? Evergreen, if you never pay down the line of credit? That is not a good word, right?
Yeah.
If you have a line of credit, you got to use it. Pay it back, use it, pay it back, use it. Don't have it be stale.
Don't just pay interest on it.
Show activity on it. A lot of times you guys will get deposits for several $100,000 and you'll have a line of credit. Pay that overnight, take that line of credit down. Show them that you're smart about banking, cash management.
Cash flow, cash management.
Show them that you're smart. The smarter they think you are, the better. They're more likely there to loan you money.
And the other thing, try to have available lines of credit so that if a deal comes through, you have the ability to borrow. I mean, I think I was talking to Matt yesterday. He said they are conservative. They want to have excess cash, and they want to also have excess availability, probably in case a deal comes through, right? We're going to go through and say, we can get it done right now. We don't have to go through the banking process.
We're just now finishing up some development projects from 08, 09 that we were able to capitalize on because
It takes that
you
long.
could react that quickly, right?
But if you don't have a line of credit right now, go get a line of credit. Get it approved. Borrow the money. Pay it back. Make it sit there so that it's available to you so that if you find an opportunity, if you find some land that you got to buy, it's there. Show the banker you know how to handle money.
Get the loans while you're doing it.
Right.
Well, is that what they're saying? They'll
Right.
give you the money we don't need it.
When
They
you
won't
go-
give you the money
yeah.
we need it.
When you go get the loan when you need it, that's not the time. You want to make sure you set it up now. You're all doing good. Set it up now.
Yes.
We had a line of credit and we used it a little bit in that, but I just took advantage of it and bumped it up a little in this period.
Right.
Like, you know what, can we raise that 50%?
Right.
Yeah.
And,
No problem, right?
Paperwork, but it was
Yep.
real easy and now it's
Yep.
50,000 more.
Right.
Yep. And it
Right.
probably
You never
wasn't
know.
that painful, was it?
No,
No.
you don't think about it.
Right.
Right.
How much should we try to get?
Bunch you can.
That-
As much as you can.
I'm not being.
Ask for it
No.
until they stop.
Absolutely.
Say, give me as much as I can.
No, you don't say that.
No.
If you don't have one, start out with, say, 50,000, something like that, and every year bump it. I mean, understand what you need, but at least start with something. And the worst thing you can do is not ever use it. At least show some activity, because I think you're a banker. Don't they have to reserve that?
It is
So-
reserved, because it is a loan know their balance is zero. So,
It's a commitment on their
Absolutely.
balance sheet.
so like
It's
when they do
considered.
the financials on you, like to do the analysis, they're gonna do the analysis as if you pulled out the entire $50,000, the entire $1 million on that line, to make sure that the day that you call it, or the day that you go say, hey, I need that million, that you can pay it back.
Okay. And here's another thing. This is what banks are doing nowadays. They want the entire relationship. If you give them the entire relationship, they're going to be more happy with you. They want your debt, they want your deposits, they want your mortgages, they want to take care of you in the trust department, they want your retails, your credit cards, things like that. They will look at that entire relationship, and the more of that relationship they have with you, the better you will be to them. Because they make money in all those different areas. Go ahead.
They don't make bonuses on loans anymore, they make bonuses on deposits. Because the government outlawed the commissions on the loan side, so that's why they want your deposits real high.
Yep. Yeah. No, that is, they really are in deposits. As we said, evaluate all long-term and short-term debt. This is the one thing you get, read all loan documents. Your business owner won't do that. You read it and you get a yellow highlighter and highlight the things that you say may be negative or things that they may want to be concerned with. What I have seen clients do, they will come to us and say, hey, I signed my loan documents, what do you think? Our response then is it doesn't matter because you
Right.
signed them. Usually what you
Done.
look at what? What's the payment and what's the interest rate? That's about all people look at.
People
They-
don't look at the guarantee. People don't look at the spousal guarantee. People don't look at the restrictive and negative covenants. What are those? You've got to maintain a minimum of $500,000 in net worth. What if you don't have it? What if you lose money? You've got to have all of your companies sign. So your real estate company now has to sign for the construction company. Construction company fails, real estate company fails. Your wife has to sign. Your husband has to sign. All of a sudden, everything you own is drug into the process. That's why a lot of times when we see in a small builder the husband and wife owning the stock, we're going, oh my God, why would you do that? If you have a fatal event, all of it, everything you own is destroyed. Get the wife or the husband, pick one, get rid of them. Have all the assets, personal assets in their name, have the corporate assets in the person that's a stockholder. That's it.
We talked a little bit about that last night, the 50/50 owner,
What's that?
then our house.
Yes.
Right. So,
Yes.
so here you are, your business is 50/50, and your investment account is where? Is it in a trust? You know, you got to look at everything. Your attorney should look at everything because with you both being owners, you both are responsible for liability with the homeowner. And when you build a dream, they get mad when it doesn't go right.
But as far as our personal house, that's in a real trust.
Real estate trust? Okay.
You
good.
know, we hear trust all the time. We hear it's in a trust, it's in a trust. Is it titled in the trust? Did he transfer the title in the trust? Is the trust properly maintained? Is it properly written? I don't know that. We trust attorneys so much, it's all taken care of. Yeah, right. We've seen it the other way. Okay?
Well, that's another thing you guys could do. One of the best things you could do for the business owners, tell them to go see their attorney and CPA and really update their estate plan and get everything in trust. Most people don't do that. They think about it, but they don't do that. And if you need any help, call us. We'd be more than willing to help. You really need to do that.
One of the greatest things we've seen recently is that everybody puts all their assets in trust, all their stock in their construction company. It's in trust. Okay, you have a bad day. You become disabled. Who's going to run the company? The trust? Does a trust really know how to run a building company? Or is it your key person? Is it your spouse? Do they really know how to run a construction company? Or is it the key people? So you need to have a document that says, in the event of my inability to perform, either I have a friend builder in my community to run it, or I have key people who maybe have one vote, the trust has one vote, and there's a tiebreaker vote if they can't agree. But to let a trust, a lawyer, run your company when you're disabled or dead for your family to retain value, I think that's silly. But that's what they used to do. The trust will run it. Are you kidding me? Seriously? Okay.
So we talked about renewals. We also should be aware of timing. You know when your loans are coming due. I have seen a lot of builders do this recently. They are trying to get a line of credit that renews every 2 years. And they've been pretty successful at doing that. I mean, yes,
Lines of credit,
business lines of credit.
these are,
Revolving lines of credit, right?
Most of them are collateralized.
Most of them are
Yeah, most of them
collateralized.
are. By either your personal guarantee or by, say, real estate or lots or things like that. I have 2 clients that have lines of credits that are unsecured, but you ought to see their balance sheet.
Yeah.
So, I mean, 2. I can say, well, I have 2 of them. You know, what we say, just like what Steve said, request a line of credit increase annually. It's one thing to go from $50,000 to $75,000 to $100,000. It's another thing to go from $50,000 to $150,000. You might not get that, so do baby steps. And just do a little bit every year. And the odds are, I mean, did they give you any pushback when you because you didn't go crazy. You just said, I want to increase it a little bit. Is what you want to do.
You know, we think our line of credit's 350 or something.
And what'd you go to?
Might have gone from 3 to 350.
Yeah.
Yeah.
So it wasn't
You know,
huge.
And we probably only used it, borrowed 50 at the most, I think. or
Right,
60,
but it's there.
And paid it back. So,
Right.
but
It's there.
like, we've never gone anywhere near it, but.
Yeah, it's there for the
But you
perfect
have that
deal.
activity.
It's there for the perfect lot. It's there.
Yep. Do you have a comment?
I have a question. A lot of the banking that we did was on collateralized, but they looked at a lot of networks too.
Yeah.
You guys see that?
Mm-hmm.
more
Well, that's
than-
why they asked for that personal financial statement.
Right.
Yeah.
Yeah, absolutely.
And when you do the personal financial statement, the bank gives you a form to fill out. If you read the bottom of that form, it says, I will notify the bank of any changes in my personal net worth. I certify the above to be correct. Are you kidding me? Put it on a blank form. We've got a blank form, sign it
Well-
on the bottom.
And then they may make you just sign their form, but you don't put the stuff on their form. They
Right.
still may make you sign their form.
Right.
And we always say be conservative with that.
Be conservative.
You know-
Don't put that piece of art that you bought when you were drunk on a cruise ship, right? You know the night you were drunk, your wife was hot, you were drunk, and everything was going great, and you saw this painting and it was $5,000 and you bought the stupid thing. You come home and you put it on the wall, everybody's going, "Eesh, what is that?" You put it on your personal financial statement as $5,000. Who are you kidding? You couldn't get rid of it for $100. It's a dog picture. Come on, are you kidding me? Don't lie. If you exaggerate on your personal financial statement, who does it hurt? You. It hurts you. It hurts you if you get divorced. I was worth $5 million last week. Now I'm divorced. Your Honor, I'm only worth $500 today. Yeah, right.
I had that happen to a client. It wasn't pretty.
They don't believe it. If you put down $5 million in net worth because you exaggerated everything, you go to divorce court, they're going to pull that up. The bank's going to pull that up. They're going to say, you told us you were worth $5 million. Where's the money?
What
If you
happened in
list
this?
everything in great detail, they're going to say, where's that asset? If you put land on there that you own or buildings at $2 million and it's only worth $500,000, where is that building?
So here's what happens. You have 2 choices. Okay, my financial statement was incorrect. So does that mean you committed fraud? So you got 2 bad answers right there. So you got to be careful. Jim's right. Be conservative. Be conservative. with that.
conservative.
I mean, be realistic, but be conservative. Okay, and we also talk about, as we said, financial covenants. This is where you guys can be of most help. Let the owner know the financial covenants. And then calculate them and say, you know what, we're good. We had one client one time, I told the banker they can't sign because the minute they sign, they're going to violate those covenants because they're not there.
Right.
So we can't, and I told the client, you can't sign the piece of paper. So really, you know, they may have certain things in there. You know, they have what we call negative covenants because it requires the borrower to behave in a certain way. We have seen things like in S corporations where it says the owner can only take distributions to pay taxes. How many of the owners in S corp only take distributions to pay taxes? None of them. Is that what you do? Okay.
That's
But
good.
you don't want the bank to tell you that, do you? If you want to take an extra $5,000, you should be able to do it. But
Right.
we have seen that in loan documents. So you can go to the bank and say, you know what? Be reasonable. Maybe it's taxes plus whatever, or get to a certain point. So really take a look at that. And this is your responsibility to read them because the business owners probably won't, or they may want you
Right.
to interpret them for them. And if you want your CPA or attorney to read them, make sure they don't sign them before we look at them. You can't do that.
Have a say.
And then we say, you know, what level of financial statements required? Is it just tax returns, compilation, review, or audit? I know a lot of you guys probably get away with tax returns. Yes? That's the lowest level of service we do for a reporting standard. We will do your financial statements. We say we're not responsible for anything, that this is all management's information, basically. So that's the lowest level of service as a CPA. A lot of our clients, just like you guys get reviewed, we do a lot of reviewed financial statements. And then for for-profit entities, we probably only do a handful of for-profit audits. But we don't do a lot. Basically, we have to do more analytical review. We have to look at you and say, okay, and we have to do more inquiries. We have to ask you more questions is what we have to do.
Sales went up, is work in process up?
Yeah,
Our
we
cost
analyze
up.
things.
Is inventory up? We look for relationships
Right.
that have meaningful sense. Compilation, we take your numbers, put them on a piece of paper in a report format. We look at all of the accounts. We make sure that every account's
The
reconciled.
balance sheet account, we look at all balance sheet accounts.
We make sure everyone's reconciled because we believe that we have a duty. We believe that you expect us to look at everything. And if we don't, you kind of look at us and go, why didn't you do your job? We don't have to. We do it as a firm because we can't help you if we don't know what's in your accounts.
And then with the review, we make sure you sign a management representation letter so you know that you're responsible for things. So more like I said, Jim's analytical inquiries and a review is what it is. An audit, we basically don't believe anything you tell us.
Generally, you don't need to do an audit. I don't see many builders at all with audits. Who here does
I would
get
say
an
these
audit?
guys maybe.
Right.
Do you guys have an audit? Well, this just the sheer size that they
Just,
are.
you
And I'm
know-
assuming you guys probably have an audit, don't you? Really? Okay.
Right.
I thought maybe you guys would too with your size. Okay. And Ashley, you said you get a review, right?
Compilation.
I'm okay. Wow. Wow. Does anybody else get a review? I thought you said you got a review. Yep. You know what do you a comp or just tax returns? Oh, okay. Well, good. You must have a pretty solid balance sheet then.
Yep.
Good.
Compilation, because what I did mine is that I just printed off my balance sheet, nothing else.
That's considered for the bank just an internal
That's internal.
financial statement because you did it internally. You didn't have the outside CPA put his report on there.
Is that a compilation?
No,
No.
no, it's internal.
Compilation is when we do it.
Yeah, it's got to be done by an outside CPA firm.
Right.
Yep.
Okay.
Then we talk, like we said, we evaluate this. Are there financial covenants? We said this. Remember we went through these ratios yesterday? We did that for a reason because you guys probably have some of these. The third one we're seeing more and more, that cash flow coverage ratio. Why do they do that? They want to make sure you can pay your debt back. And also a tangible net worth. A lot of you guys probably, the first two, those have been common for years. The last two, we're seeing more and more banks put those in there. And what you want to do is say, okay, what is the cash flow coverage ratio? Is it 1.25 to 1? Is it 1.5 to 1? What is that? And you need to calculate it. The other thing we're seeing, years ago, the banks would make you do these ratios at the end of the year. I'm seeing them done more and more quarterly now. Does anybody have to do them quarterly for them? I'm surprised. You guys, I bet you guys have to do them quarterly now. But we are seeing, because you get your books ready for year end, well, and I think the bankers got smart. Well, I want to see it quarterly to see what you can do because you got to plan for it. And this is where you guys, even if you don't have them, I think you should do this to help your owners out to see where you guys are going. Said, tangible net worth adjustments, what they do is related party receivables, they'll throw those out. Intangible assets, goodwill, things like that, they're going to throw them out. And they will tell you, most of you guys, for some of your inventory, don't do it. With other types of industries, they only give us 50% of credit for inventory. I don't think in your industry they do. They probably give you 100% credit, don't they? I don't think they do that. You
If
might want to ask
contracted.
them, I guess. I don't know the answer to that. And other things we talked about, subordinated debt.
Subordinated debt is if you loan money to the company, right? And you subordinate the repayment of that debt to the bank debt. The bank debt's in a first position in front of you. Becomes second position.
What I would do is if you don't have to, do not sign a subordination agreement. Because just like Jim said, the only thing you can get is your interest. If you pay the principal back, you got to get the bank's permission. It means you are subordinating that to the bank. You are going to leave that on the books. So try not to sign a subordination agreement. That's what that means. They're basically telling you what you can do with the money you lent back to the company. Even though it's your money, you are not in control anymore. Like I said, are there limitations or restrictions? The bank should, at a minimum, allow tax distributions up to the maximum federal, state, and local statutory tax rates. got to go max because you never know what it's going to be. That should be a minimum. If they put those restrictions in, you make sure it says the maximum. Because you don't want them to say you can have distributions to pay taxes up to 40% of income. What if your tax rate's higher than that? In Ohio it is, because we got our federal, we got our state, and unfortunately we got local taxes, and sometimes we have school district taxes. Did I forget anything else? It's like we have all kinds, don't we? I mean, literally, for you like this, I have to pay federal tax, state tax, city of Perrysburg tax, and a school district tax to the town of Perrysburg. If I would work in the city of Toledo, their tax rate's 2.25%. I don't get the full credit for that when I pay my Perrysburg tax, so I have to pay a little bit of both. I mean, it's just odd the way, I don't know why we just don't make it all the same around here. We're one of the few states that has city taxes.
They're trying to do it.
Are they trying to do
Yeah,
that?
they're trying to do it. But
Yeah, income taxes, yes. We're talking
what we're saying, though, is that the agreement with the bank, the document should state that you're allowed to make distributions, and it should state up to the statutory amount. Statutory amount is whatever the law is what you pay. If you say 50%, you might be in, what is the maximum federal
Is it
tax rate?
39.6 or something like that?
Plus state, plus local.
And self-employment, you got to remember that.
Self-employment tax, you might be over 50%, and they might come back and say, oh, you paid more than 50%. That's a violation. We pull the note.
Do any of you guys build in more than one state? Does anybody do this? You do? Really be careful. The states are coming after that. It's their money. I mean, even though you might report everything in Kansas and you build in Missouri, they're going to say, sorry, you should have paid this state tax and the other. We have that with Michigan, Ohio sometimes, where it's like, okay, we should have reported in Michigan, we didn't. Okay, give us our refund back in Ohio. These states are broke. Yeah. The other thing, if you build in different states, understand the sales tax law. Because where the material is delivered, like from a vendor versus you delivering it, depends on where you pay sales tax, at least in this area. So that's a big thing too.
That's an issue I have with our states on our retail side, it's where they touch it.
Okay.
Ownership tax.
Yeah,
I
no.
would drop ship. I was talking to him about Texas, so like I would drop ship to like Tennessee or Mississippi. People who are building for our staging deal,
So you didn't touch it,
I never touched it, but they touched it.
so they have to pay in that state.
That's right.
Okay. We said, look at capital spending, alternative debt. That's what some of you guys are doing. Some of you guys are getting investors, and it would be pretty cool when you get with your Builder 20 groups, the different deals that everybody has with investors.
How many have investor deals right now? How many people have outside capital? You do?
Yeah.
Anybody else?
Yeah, you guys do.
Okay. What
Yeah.
rate do you pay,
You get-
rate of
you-
return do you pay generally?
Got a guarantee, like a first or 8%,
Right.
everything else is like waterfall.
Right on.
And doesn't it, and isn't it sort of tiered or certain price points? They have a pretty cool one too. You guys probably have something like
We
that.
just do it on land development, and it's a personal, we pay him 26% on his cash investment.
That's it. He doesn't get any part of the deal.
Right.
Okay.
Interesting.
Yeah.
But we're seeing more and more builders, small builders, you run into a capital restriction. The banks don't want to loan you money. What do? You want to build a model home. You want to show people what you can build. You want to build a spec house because you're slow. What do? You don't have the cash. You don't want to take your cash. Can you go out to someone and say, look, I'm going to build this model home. You're going to own this model home.
We'll lease it back.
I'm going to pay you rent. We're going to lease it back from you for 2 years. At the end of that 2 years, I'm going to sell that for you, and I'm going to make sure that you get back 100% of your money plus the interest or the rent that I paid
Right.
you, and I'm going to get you a preferred return of 8%. What about thinking that way with a model home?
Gets off your books. Now, how many of you guys own your own office building? Aren't there a few of you guys here? If you guys do, you guys make sure that you have what's called a triple net lease. You have a lease between you and the company, and make sure you sign it so that it's legitimate. And a triple net lease says that the home building company will pay all the real estate taxes, all the insurance, all the repairs, all the maintenance. All you have in your building company is you get a lease payment and you pay your mortgage. That's it. It's that simple. Everything else is on the home builder or whoever is leasing it from you. It's called a triple net lease. And the other thing you want to make sure is you're supposed to lease it at fair market value.
Yep.
If you exceed fair market value, it's not that big a deal if you're an S Corp or LLC, but if you're a C Corp,
C
they can
Corp.
come back and they can call it a constructive dividend. So you're good? And you know what we do sometimes, like in your case, maybe get a letter from a realtor, a commercial realtor, and say, here's what the market rates are. So you got it from an outside third party. We've done that many, many times to say, hey, it just wasn't us thinking, this is the professional. This is what they said rates are. Like we said, interest rate, is it fixed or variable? Is it tied to a recognized published rate? Not a bank rate. What are we saying there? We have some banks around here, you are getting our prime rate. That's not the Wall Street Journal prime
Right.
rate. They have their own bank prime rate.
Right.
So be careful. Another thing that we have, has anybody heard of LIBOR? LIBOR, a lot of people use. LIBOR is very, very inexpensive. So you might want to talk to your bank and say, what's a LIBOR rate? I think the LIBOR rate, some people get it less than around 2.25 right now.
Yeah, it's very
I
low.
think it's something like that.
Very low.
Like I say, it may be more variable than a prime rate. As we said, evaluate a prime rate in the near term as it may become lower, and the bank may put what they call a floor. That's their bank rate. Or they may say to you, you know, here is your rate, but it will never fall below 4.5%. This is where you have to read the documents. So even though they're telling you they're giving you the prime rate, is it their prime rate?
Right.
We talk, and this is the other thing that comes into play, a lot of refinancing penalties. A bank may, on commercial property especially, say, hey, we're giving you this rate, but if you leave the bank within 5 years or whatever, you will have a $50,000 prepayment penalty. So really take a look and see if there are any penalties for you to refinance.
Right. They're doing that almost
lot,
all the
yeah.
time now because a lot of people are financing with a bank and then within 12 months changing. And now the banks are saying you pay us 1% fee if you refinance with another bank. If you just leave the bank or pay us off, we don't care. If you leave the bank with another bank,
Right.
you have to pay a fee.
Right, and that can be hefty. The other thing, like when we do a lot of our reviews or audits, if a client is in violation of their loan covenants, we have to get a loan waiver from the bank. They have to get a loan waiver from the bank. But a lot of times they will charge them a fee for that. So that's what we're saying. You don't want to violate your covenants.
Yep.
Then they will charge you their legal fees and bank fees. Here's the things you have to avoid. If you can, cross-collateralization. You want the building to have its loan. You want the home building company to have its loans. You don't want to cross-collateralize. The banks will always ask for that. They will get everything they can.
Right.
And the problem is, once they have it, it's tough to give it up.
Right.
You know, just like Brandon said earlier, okay, I know Jim said, get my wife off the bank debt, she's on it. How do I do that? Not easy. Because once they have it, right?
Yep.
As we said, personal guarantees, spousal guarantees. As we said, consider assigning assets to your spouse. And you're right, you cannot transfer assets to your spouse if they are currently pledged to the bank, unless the bank allows you out.
That's considered a fraudulent transfer.
Right. Like
So-
we said, consider carve-outs. Let her have the house. Hopefully she'll let you back in if things go bad. That's so we want somebody to have
Not
a place to go.
guaranteed, by the way.
You know, things to avoid, guarantee of a partner's debt. That's just what Jim was talking about with Steve, you and your brothers. So make sure you try to have a pro rata loan guarantee. You know, excess collateral requirements, which is the bank's always going to ask for. They want more than what they lend you, right? That's what they want. They're going to want more than what they lend you. We've seen this, assignment of life insurance policies. We talked about year-end surprises. This is the one thing they do not like. I mean, I've gotten beaten up by bankers before on this, so what I'll do is I'll say, okay, here's the internal financial statements. We just did tax planning. They're going to put this much in profit sharing. They're going to take this much out in bonuses. Here is what we have to write off. These receivables, here is what it's going to look like after we do that. Are you okay with that? They appreciate that. What they don't like is we do that, and then we make, you know, all these adjustments for, say, depreciation and for accruals that you guys didn't make, and they're like, what happened to your internal financial statements? They don't like that at all. So that's what we're saying, the better you can keep your books, the better it is for everybody,
Right.
and we don't want to make a lot of journal entries. We can explain year-end journal entries for tax planning. We can explain profit sharing. We can explain bonuses. They get that. They don't get the other stuff. So then what they're saying is, okay, you send me these quarterly financials. They don't mean anything. The last thing you want to do is have them come back and say, well, now we need a compilation quarterly from your CPA. You don't want to do that. So if you can avoid year-end surprises, that's the best thing you can do with a banker.
That's why if you're showing a profit for 2016, maybe you want to accrue some bonus. Maybe what you want to do is accrue 50 grand a month so that when the owner does make that decision, does meet with the CPA in November, and they decide to pay a $300,000 bonus, the bank doesn't get surprised.
It's accrued. It's already
It's accrued, it's on there.
Right.
We know we're going to do something, we just don't know what it is yet.
Right. As we said, we evaluate other potential sources of financing. If you have equipment, maybe you need to lease it versus buy it so you don't tie up your capital. SBA programs are not bad. If anybody really has issues with financing, SBA is not a bad route to go.
Anybody do that? Anybody do it here?
So-
SBA has a lot of upfront fees and a little bit higher rates, so you're going to pay 5.02, and you're going to pay $25,000 of fees, but you get the money, and it's guaranteed by the SBA. It is an option. It's not something we see a lot of people do. Usually, it's something that's done when there's limited collateral and/or cash flow, because banks require collateral and require cash flow. SBA will pick up one of those. If it's a viable.
And they may have a longer line of credit term too.
20-year amortization
Right.
as opposed to 5 with a bank.
Right. And there may be other programs in your area. There are certain loans in this area that we can help clients get. So in your areas, contact either your economic development department or your chamber of commerce. There are opportunities out there for you. We don't know what they are in your area, but we know there's some around here. So we
Port
try to look at
authorities
those.
might have them.
Right.
We had a builder in a community next to a major league stadium, and they bought land close by and built a community, and the city helped them finance the land because they said, we want that area developed. We want that. And so they did an infill program in there. Very, very, very successful program. But the city was their partner.
And as we mentioned before, be proactive with your banker. Here's what you need to get for them. 3 years. They always want 3 years of business and personal tax returns, your most current financial statements, and they want your current year-to-date financial statement and your prior year financial statement. You get that packet ready for them, and that'll be good for them. And also your personal financial statement. As we said, your personal financial statement should be kept current. As Jim said, make sure you use a non-bank form. They may make you sign their bank form, but most of them you can put in Excel and you can update it every year, and you sign it, and you do it at least annually. Another thing they do like to see, and we have a program on this, I think I've sent it to some of you guys, a business plan. You can do a detailed business plan or you can do a one-page business plan. We have examples of both. They want to say, where are you going? What are you going to do? How are you going to get there? So it's very, very easy to do. And then we also, as we mentioned yesterday, do a business budget and projection. What I always say is do 3 different ones, worst case, best case, and the most expected case, and make sure that budget's in your current financial data and do your variance analysis. The more information you give the bank and the more they think you're smarter and really managing your business, the better it is. The other thing we try to do is if we go meet a bank with a client, we try to do as little talking as we can. We don't want the bank to think that we are talking for the client. We want the bank to know that the client knows what they're talking about.
Right.
So you guys have to give the input to the banker. Have them believe in you.
Right.